Real estate is an attractive asset class, and REITs allow retail investors to invest in real estate hassle-free and enjoy attractive returns and decent dividends. Today, let's talk about Prologis, the world's largest REIT and the best play within industrial REITs. Prologis stock has outperformed both Nasdaq and S&P 500 in the past 5 years. Its share price has increased 76%, significantly higher than Nasdaq and S&P 500. In the same period, Prologis grew its dividend at a 12% CAGR, doubling that of REIT on average and more than doubling S&P's dividend growth. As a result, Prologis has delivered approximately 20% average total shareholder return over the past 5 years. Very attractive. We like Prologis for many reasons. Number one, diverse customer base with a focus on consumption. Its 6,300 customers span across multiple industries in 19 countries. Number two, high-quality properties focused on high-barrier, high-growth markets. Prologis' modern logistics facilities are concentrated around major population centers and urban areas where lands are scarce. Number three, differentiated strategic capital and value-added services. Prologis uses a capital-light, high-margin investment model to complement its core business. It has already deployed $100 billion of capital in investment, a true differentiator compared to other REITs. Number four, proven development track record and a significant development-ready land portfolio. Over the past 2 decades, Prologis has invested $40 billion in developing properties and already generated $11 billion in value creation, or a more than 27% return. Number five, low-cost operating structure. Prologis' overhead expenses are only 0.4% of its total AUM, truly best-in-class among industrial REITs. Number six, strong balance sheet and liquidity. With $5 billion in cash, low leverage, or low debt, Prologis is able to access debt capital and an attractive interest rate of 2%. Last but not least, secular tailwinds. Prologis is set to benefit from increasing e-commerce penetration accelerated by the pandemic, as well as heightened focus on sustainability. Welcome to Safety. In this video, we'll analyze what the company does, what we like about it, and when to buy the stock with our suggested entry point at the end of the video. Stay tuned.
Okay, so let's dive into what this company does.
Prologis owns, develops, leases, and invests in logistic real estate, meaning warehouses and distribution centers that are key to storing and moving goods around. The company was founded in 1983 and IPO in 1997. It's headquartered in San Francisco. Over the past 4 decades, Prologis has benefited a great deal from the rise of global trade and the rise of e-commerce. Today, it's a $5 billion revenue company with a $103 billion market cap. It's the world's largest REIT.
Prologis has a very diverse customer base. Its customers span across multiple industries. For example, the third-party logistics, such as UPS and DHL, are their customers. Retailers, such as Amazon, Walmart, and Home Depot, they use Prologis as well. And of course, the wholesale companies or like consumer brands such as BMW, PepsiCo, and Bridgestone, a tire company. Manufacturers such as 3M and Samsung. And of course, the transportation companies such as FedEx and Maersk. Basically, all these customers, they need some space, real estate, such as warehouses and distribution centers to facilitate logistics as part of their transportation and supply chain management. Overall, Prologis has over 6,300 customers. Let's take a look at different type of distribution centers that Prologis owns and operates, and the role that they play in our daily consumer lives. As a modern day consumer, we take shopping for granted. For example, whether you buy your products in store, for example, at Walmart, Costco, or Kroger, or whether we order them online via Amazon or Instacart. But there is an entire supply chain that is happening behind to make this convenience happen. For example, take an example of when you order sneakers or shoes, they could arrive from China or Europe, from overseas, via ships and containers, or they could be coming from Canada or Mexico. At the port of entry, these sneakers and shoes have to be stored in distribution centers called gateway distribution centers. So these are close to the point of manufacturing, but they are close to also the access highways or the ports of entry, and of course with the infrastructure like electricity or storage as well. From there on, let's say these sneakers and shoes arrived from Europe or Asia to Los Angeles or LA, and you are living in Chicago or New York or Miami. In the process, they have to be stored in intermediate cities or intermediate markets, which are called multi-market distribution centers. From there on, if you live in Miami, Miami has to have a dedicated city distribution center. So that is specific to storing inventory for the local shoes and sneaker needs of the Miami market. So that's where the city distribution comes in, where you order online, it has to come in 1 or 2 days after that. Or if you order for the same day delivery, there are last touch facilities. For example, you live in Brickell, there has to be a last touch facility where you ordered some Nike shoes or Adidas shoes. They have to be delivered on the same day. So these last touch facilities are within your sub-zip code or local radius of where you live in Brickell within Miami. So these places, the city distribution and the last touch, as you can imagine, the land in Miami or close to Miami is extremely scarce. So Prologis has an advantage of procuring and having these facilities, logistics facilities, close to where you live in Miami or close to where we live.
Prologis has an unmatched global presence and scale. They own and operate 5,300 buildings totaling 1.2 billion square feet, spanning across 19 countries on 4 continents. Their properties and assets are worth $188 billion. North America, meaning US, Mexico, and Canada, is their biggest market, with US accounting for 2/3 of the building. In terms of international markets, they have presence in Brazil, which is the largest economy in Latin America, all of Europe, and in Asia, in China and Japan, again, the 2 largest economies in Asia. The benefit of being a global logistics real estate company is that Prologis can be a one-stop shop solution for multinational customers' logistic needs who sell goods all across the world. Prologis operates in 2 business segments. The first one is real estate operations, which is the bread and butter for Prologis and generates 88% of their total revenue. Here, Prologis basically lease out their properties to customers and collects rent as revenue. Lease terms are usually 5 years. The second segment is strategic capital, which is very unique in the world of REITs. So instead of owning 100% of the underlying properties, Prologis co-invests with institutional investors such as sovereign wealth funds and private equity, especially in international markets, and holds a 15 to 50% stake. This basically allows Prologis to cover more ground internationally while being efficient with their capital. Prologis also leverages its expertise in managing the underlying properties, such as acquiring the land, developing properties, finding tenants and leasing them out, collecting rents, and do the day-to-day maintenance, and hence generates a fee-based revenue stream based on the service that they provide. This is extremely profitable. In particular, the profit margin is 80% for this revenue stream.
In 2019, Prologis launched a new type of business called Prologis Essentials, providing value-added services and solutions for their customers. If you take a step back and think about who Prologis customers are, they're either like manufacturing brands such as PepsiCo and BMW, whose primary business is to develop, manufacture new products and market them to end consumers. The other type of customers are transportation companies whose primary job is to transport goods from one location to the other. Although each of them, all their customer base do rely on warehouses and distribution centers, none of their core competency is to operate effectively and efficiently these warehouses. This is where Prologis value-added services comes into play, providing these extra value-added services to their customers. For example, in terms of warehouse operations, they do rent out equipment such as forklifts, racking systems, generators, even office furniture and design. In terms of energy, we all know how corporations are moving towards environmental sustainability goals and sustainability reporting. To help with that, Prologis offers or equips their warehouses with like smart roofs and smart metering, and even also how much carbon has been captured or emitted as part of these operations. Another value-added segment is in terms of mobility. So Prologis started offering EV charging stations and also plans to offer electric fleet for their customers, in addition to managing those fleet as a solution. Interestingly, Prologis also offers workforce solutions to its customers. For example, the primary goal is to help their customers find labor. Think of all the labor shortage that is happening nowadays, and this is where Prologis can help their customers find workforce, but also train them. Now we know how warehouses are deploying like robotics. So how do these labor work in tandem, hand in hand with robotics and automation that is happening in the workforce? Last but not least, Prologis also offers a suite of data and digital solutions. Nowadays, think about when you order a product from a retailer, you can track it that if it left the factory or it left the manufacturing facility. Now it is in a warehouse. Now it's in the last mile distribution center, and now it's on the way. So you have to track each and every package or product that people ordered. This is where Prologis, one example of how Prologis is providing a value-added service.
As we all know, REIT's primary business model is to rent out real estate and earn rental income. The fact that Prologis is able to offer these value-added services is very unique. We have not seen any other REITs in industrial or retail that do the same thing. So despite being the largest REIT, Prologis is very innovative, always trying to stay ahead of customers' needs. Prologis Ventures is the venture capital arm of the company. Prologis has so far invested in around 30 startups in all aspects of logistics operations. These startups are at the forefront of innovation and works on cutting-edge technology that address the biggest pain points of Prologis customers. For example, a startup called Flexport, aka the Airbnb of warehousing, it allows customers to rent underutilized warehouse space to handle overflow inventory. Through these venture capital investments, Prologis can quickly identify and pick out winning technologies and roll them out to their massive customer base.
Prologis is a clear market leader in the industrial REIT segment. When you look at the other largest REITs that play in the industrial segment, you might come across Rexford Industrial, that is mostly based out of California and also New York, and East Group Properties, that is focused on the Sunbelt growth markets like in the southern US, and then First Industrial, that is spread across 20 plus major cities in the US, Stag, which is all over the US in 40 plus states, and Terreno Properties, which only focuses on the coastal markets. However, the key is that if you look at the market cap or the revenue or the number of properties of Prologis versus these five other largest industrial REITs, none of them are more than 1/10 the size and scale of Prologis.
Prologis has delivered solid financial performance in the past 5 years. In terms of total revenue, it has grown at a CAGR of 14%. This is despite the fact that Prologis is the largest REIT in the world with revenue of 5.2 billion in 2021. In terms of core funds from operation, think about this as free cash flow for a regular company. So for FFO, Prologis has grown at 18% CAGR, faster than revenue growth. Prologis pays a decent dividend, and as a matter of fact, it has been growing its dividend at a very fast rate. In fact, they grew dividend twice as fast as overall REIT sector and S&P 500. Leverage is an important metric in the world of REIT because REITs take on debt constantly to finance the acquisition of new properties. Prologis has decreased its leverage from 5.6 times in 2016 to 4.7 times in 2021, despite making multiple acquisitions in the same time period.
Now that we talked about what the company does, its basic business model, products and services, market leadership, and who it competes with, and the financial performance, now let's discuss what we like about this company.
As a recap, we like Prologis for 7 key reasons. Let's dive in.
First reason being its diverse customer base of 6,300 customers spanning across a diverse range of industries, ranging from third-party logistics through retailers, through wholesalers, through manufacturing and transportation. In fact, the top 10 customers of Prologis contribute less than 17% of the total rent it collects, and the top 25 contributes less than 23%. So there is no key customer or key client risk that Prologis has, hence very diversified. The second key reason why we like Prologis is its high quality properties focused on high barrier and high growth markets. As an example, these properties are very modern with strategic location. In real estate, we know it's all about location, location, location. So these logistics facilities of Prologis are uniquely located next to infrastructure, for example, next to electricity grids and next to transportation networks, meaning close to interstates and highways and intersections. In addition to that, these are modern in the sense that these facilities come pre-equipped with solar panels, for example, and EV charging infrastructure and lot of ventilation for the warehouse workers and LED lighting. All in, Prologis is not only catering to today's customer needs, but it's also future-proofing its facilities for tomorrow's customer needs. Prologis has these high-quality properties in very attractive markets in what it describes as high barrier, high growth markets all across the world. Basically, these are major population centers with a lot of consumption. For example, if you look at 14 of the top markets within the US, such as Atlanta, New York, Miami, LA, or San Francisco, outside of US, Brazil with 200 million population, Mexico with 150 plus million population, and in Europe, basically the Western Europe like France, Germany, UK, Netherlands, where the consumption is high and once again high income population. In Asia, China, the world's largest population country, and Japan and Singapore, where people are rich and consume high. So these are essentially very attractive markets, but also because of this population, the available land is very scarce. So it is high barrier for entry for any new REITs to enter and disrupt, where Prologis has a competitive advantage.
The two important differentiators for Prologis is their strategic capital business and their value-added services, or Prologis Essentials. We discussed this in what they do section, but I want to put strategic capital business in context and show you the scale and profits it brings to Prologis. In terms of scales, the underlying property value of the strategic capital investment has doubled from 2018 to 2022. Along with it, Prologis has grown its earnings from strategic capital at a 22% CAGR in the same period. Another piece of the puzzle is what we call net promote income from Prologis investment through strategic capital. Basically, in plain English, when the investment return exceeds a certain threshold, Prologis is entitled to a higher proportion of the investment return. This is amazing because it drops directly to Prologis bottom line and increase its profitability. All in, even though strategic capital is only 10 to 15% of Prologis' total business, it's highly profitable with a 80% profit margin, which means strategic capital's revenue, 80% of it contributes directly to Prologis' net earnings. In addition, we already talked about how we like Prologis Essentials business that offer value-added services to its customers. For example, they offer racking systems and forklift within the warehouse, as well as electric trucks and charging infrastructure. In addition, training for warehouse workforce. Although Prologis Essentials is still in its early innings after launching in 2019, it has strong potential to scale to all 6,300 customers Prologis serves. We also like Prologis because of its track record of developing new properties and a significant portfolio of development-ready land. For example, Prologis has invested $40 billion in development and has created $11 billion of value creation of the $40 billion, which represents a 27.4% margin. This is a very extraordinary risk-adjusted return.
In addition to having this proven track record of last 20 years, Prologis does also have a significant development-ready land portfolio spanning 227 million square feet, where Prologis is expecting to deploy an additional $37 billion of capital equity. In fact, this land portfolio is spread across very attractive markets. For example, California, Mexico, UK, and Germany. Another key reason why we like Prologis is its operational efficiency. It has a very low cost operating structure. If you look at their G&A expenses, meaning general and administrative expenses such as salaries and other administrative expenses, these expenses only comprise around 40 bips, meaning 0.4% of its total assets under management. If you look at the left-hand side chart here, you can see that the assets that Prologis has is significantly growing over the last 10-11 years, while its G&A costs are coming down as a percentage of these assets. So it's a high growth company becoming more and more operationally efficient. If we compare Prologis operational efficiency against other REITs and other blue chip companies, Prologis in fact is Prologis G&A expenses are 35% less compared to other industrial and logistics REITs, and 50% less than other blue chip companies.
Another reason we like Prologis is their strong balance sheet and liquidity. It has one of the best credit rating from major rating agencies, and that is because of its low leverage. Either you look at it as debt to market cap or debt to adjusted EBITDA. As a result, Prologis is able to access debt financing at a ridiculously low cost, or 1.9% interest rate. Compare that with Fed funds rate now standing at 4.5%, that is ridiculously low. Access to debt combined with its own liquidity or cash on balance sheet of $5.3 billion, Prologis has a total investment capacity of $12.7 billion. That means Prologis right now can deploy $12.7 billion of capital in order to capitalize on investment opportunities. Either it's an acquisition of new land or properties or acquiring another competitor.
In addition to these 6 key reasons that are very specific to Prologis performance, we also believe Prologis is best positioned to benefit from broader circular industry tailwinds such as e-commerce and environmental sustainability. 20 years ago, right after its IPO, Prologis has made a bet and invested heavily on e-commerce as a trend, and that has been paying off. So if we look at the e-commerce penetration as a percentage of total retail sales within the US in the 31 markets that Prologis operates in, it has been growing steadily until 2019, reaching about 15% market penetration, e-commerce penetration as a percentage of total US sales. And then the pandemic, the COVID pandemic has happened. When the e-commerce has exploded, imagine all those days in the last 2 years when we used to order everything online. So that has catapulted the e-commerce penetration within the US. And in 2022, it almost reached more than 20%. And it is projected to grow. In fact, in the markets outside of US where Prologis has a big presence, e-commerce is already a big trend. For example, in China, it's 46% penetration, UK 36, Europe 41%. This explosion in e-commerce has been evident if you take a look at Prologis occupancy rate over the last 6 and 7 years. Historically, this occupancy rate of Prologis, meaning what percentage of properties have been occupied with tenants, has been around 97%. However, since pandemic happened, when because of the COVID, e-commerce accelerated, Prologis occupancy rate has bumped up to 98% in 2022.
And this high occupancy rate has contributed to tremendous rent growth for Prologis.
Given the historically high occupancy rates and henceforth the ability to increase rents for Prologis, let's imagine a scenario where there would be a recession in 2023, like most economists are predicting to happen. Taking a look back at the last 35 years, there have been 4 recession periods or recession environments. During each of those recessionary periods, the vacancy rate, meaning the number of warehouses or properties that go unleased or unrented, they have gone up during each of those 4 periods. So the average vacancy rate in this last 35-year period has been 6.4%. However, given the e-commerce bump and everything in the last 2 years, the current vacancy rate in Prologis 31 markets has been historically low at 3.3%, meaning half of historical average of 6.4. So even if there were to be a recession in 2023, at the most, this vacancy rate should go back or revert to the historical average of 6.4, but not beyond that.
In addition, even if we consider the currently under construction warehouse space, or assuming they come online ready for rent, the modified vacancy rate would be still below historical average, hence supporting continuous rent growth.
Overall, to wrap up what we like about Prologis, it's a solid industrial REIT stock to own. It's not only the world's largest REIT, it has properties across the most attractive and lucrative markets across the world with a differentiated strategic capital model and best-in-class operational efficiency. On top of all of this, it's also innovating via its Prologis Essentials value-added services and also innovating via its Prologis Ventures. So overall, great REIT stock to own.
In our view, Prologis is reasonably valued despite its strong performance versus peers. In terms of revenue growth, Prologis delivered 14% revenue CAGR from 2016 to 2021, which is in line with the peer median of 15%. This is despite the fact that Prologis was growing from a much bigger base. It's 10 times as big as its peers. In terms of profitability, Prologis delivered a 58% FFO margin. It's much higher than its peer median at 54%. In terms of leverage or net debt to EBITDA, Prologis has the lowest leverage among its peers, with net leverage at 4.7 times, lower than peer median at 5.3 times. Prologis delivered a decent dividend yield of 2.7% in line with peer median of 2.8%. Most importantly, Prologis has delivered a 5-year total shareholder return of 93%, best in class among all its peers. Although Prologis has delivered strong performance, its valuation is not necessarily out of range. In terms of price to FFO, It's in line with peer median at 21.1 times, and in terms of price to adjusted FFO, it's actually trading below peers. And so in our view, the market has somewhat undervalued Prologis.
As a quick reminder, P/FFO is a valuation metric used for REITs. It is equivalent to PE ratio that we use for normal companies.
Since Prologis went IPO about 25 years ago, it has delivered outstanding total shareholder return and outperformed major indices. Prologis delivered an average annual shareholder return of 11.5% over this time period. That is almost doubling Dow Jones Industrial and S&P 500 and 25% higher than the tech-heavy Nasdaq index as well as the broader REIT sector.
Now that we talked about what the company does and what we like about it, let's talk about the million-dollar question: when to buy this stock?
To answer this question, let's first take a look at Prologis' share price trajectory in the past 5 years. Even before COVID hit in March 2020, Prologis has started to outperform market starting in 2019. And then from the bottom of COVID crash to April 2022, Prologis stock has climbed 1.5 times and reaching all-time high in April 2022. And during this period, it coincides with the increased investment in e-commerce, not just from e-commerce giants like Amazon, but also from traditional retailers like Walmart and Target, trying to catch up and compete with Amazon. However, Prologis stock started to decline with the broader market from April 2022, and this is because of a few key reasons, including Fed interest rate hike, Russia's war on Ukraine, the market's assumption that e-commerce will reverse to normal after 2 years of above historical growth. In addition to that, in June 2022, Prologis made a $26 billion acquisition of its competitor, Duke Realty. The market did not seem to understand the synergies and scale that this acquisition will benefit Prologis in the long term. But overall, in the past 5 years, Prologis has still outperformed both Nasdaq and S&P 500, and we believe the recent normalization of stock price has opened up a rare opportunity for long-term investors to buy the stock. When we look at Prologis valuation over time on a price to FFO basis, Prologis is currently trading below historical average. Its current valuation is at 20.5x compared to 10-year average of 23x, 5-year average of 25x, and 1-year average of 26x. It is at an attractive level. As usual, we took a look at how Wall Street analysts value Prologis. In terms of rating, significant majority of the analysts recommend Prologis as a buy, and no one said it's a sell. In terms of target price, even at the median target price of $130, it represents a almost 20% upside versus the current share price at $112. To put it all together, what is the right entry point for Prologis? The stock is currently trading at $112, with recent low at $99, which means current share price is only 10% or so above recent low or floor. Based on 10-year average valuation, the implied share price is $128, which is in line with analyst share price target at $130. So all in, we'll be comfortable entering Prologis at below $130. Overall, Prologis is not only the best-in-class REIT stock to own, but is also a great foundational stock for long-term investors. We would buy the stock right now, and we would continue to add to our position whenever the stock dips, meaning 3% or higher decline within our comfort level of $130. Don't forget to check out our other best stock ideas and subscribe to our YouTube channel Thesis.